understand how this would turn out over the next 1-2 years in terms of your growth.
Thanks for your question. The growth for our business is driven by 4 key pillars. First is, as you rightly pointed out, e-commerce growth, given that we charge for transactions. As e-commerce continues to grow, we continue to grow with that. The second growth lever is addition of new clients. The market is fairly underpenetrated. There are many traditional brands that are yet to come online in a big way, and there are many categories that are yet to come online. The third growth driver for us is addition of new products. Our vision is to become a one-stop shop for e-commerce enablement. So we will continue to offer new solutions as far as e-commerce enablement is concerned. And fourth is international expansion. We are already present in 6 countries outside of India. Our focus is to go deeper in these geographies across Southeast Asia and Middle East. So with these 4 growth levers, we are confident of continuing to deliver a consistent growth and expanding profitability in the business.
So is it possible, since given the current activity levels or maybe the services additions or client additions, these matrices, how do we see next couple of years for us? Is it going to be organic growth? I mean, if you can give some numbers on that basis which one should expect certain delivery on the top line for you. I'm just trying to make a sense of how much growth you would pen in for your e-commerce plus addition of new clients plus international and stuff. Whatever you mentioned, if you could give some sense on how we should look at your company, maybe 2 years, if not immediate. I mean, how things should pan out.
Sure, Ashish. So one, I want to clarify that we do not offer any services to our customers. We offer a platform. So they use our solutions in a plug-and-play manner to manage their e-commerce. We as a business have delivered market plus growth rate. As I mentioned that during the pandemic, when the market grew at 30 to 35%, we delivered a 50% revenue growth. Last year, the market, as per our estimates, grew by late single digits, and we delivered a 15% revenue growth. We are confident as a management team to deliver a market plus growth going forward as well.
Okay. And how does the operating leverage play out here, given we've seen some good improvement in your profitability over the last, maybe I think whatever numbers are available. So how does this work for you? And also, if you could give some idea about how much do you charge, because it's a small fee that you would be charging for your platform. So how does that model work overall?
Sure. So our business has consistently demonstrated operating leverage because the core products, the 4 products that I described to you in the transaction processing layer are fairly mature now. So we do not need to invest a lot in those products. And hence, whatever incremental revenue growth we get, a large part of that flows to our bottom line, demonstrating operating leverage. Out of this profit pool, we continue to invest in building new products and for international expansion. And that's why, in spite of our investments that we're doing from our internal accruals itself, we are still able to demonstrate an operating leverage for the overall business as well.
Okay. So what's the kind of vision you can say, or you might have visualized how your platform would look in maybe half mature stage, maybe still growing, but as you said, the incremental investments in the business, rather the revenue traction would take over the incremental investments that are needed in the business. So is it likely to be a 20% operating margin business once the revenues grow to a certain level? Some kind of idea like that, or maybe the ROIs you can speak about in this business if whenever you see this some kind of maturity in terms of revenues and comes in. Any sense on that, if you could share?
Right. Our core products are fairly mature, so the incremental investments are not a lot that we go there. Like I mentioned, our new products, Uniship and Unireco, are currently in the build phase. The level of maturity that a product attains, the timeline for that is a function of the complexity of the product itself. But as I mentioned, that our core business continues to be significantly profitable and continues to demonstrate a strong operating leverage. And we are able to dip into this profit pool and continue to invest in new products as well as international expansion as well. And over time, some of the new products that we will be building will also reach this maturity phase. See, our vision is to become a one-stop shop for e-commerce enablement, and we will continue to offer new solutions. So today we have launched Uniship and Unireco, and we will continue to add more. So over time, these different product lines will attain their maturity stage at different points in the future, and will continue to add to the profit pool itself. But the idea is that all the brands and sellers in the ecosystem are able to get all the solutions, all the relevant solutions that they need as far as e-commerce enablement is concerned from a single umbrella, which is what we offer, and which ensures that our relationships with the customers continue to be sticky.
Okay. Sure. Thank you. So clearly I'll connect one-on-one with your team and gauge more on things. Thank you so much.
Thank you. The next question is from the line of Sumit Jain from CLSA. Please go ahead.
Yeah, hi. Thanks for the opportunity and congratulations on a good profitability this quarter. So Kapil and Anurag, firstly, just housekeeping questions. Can you just guide us what is your YOY and QOQ growth in items processed this quarter? Hello? Am I audible? Hello?
Yes, sir, you're audible, sir.
So Sumit, YOY growth for the number of items processed in Q1 FY25 is 35%. We processed 212.77 million in Q1 FY25 as compared to 158.19 million order items processed in Q1 FY24.
Got it. And how is it sequentially, Anurag, if you can tell us?
Sumit, we processed 197.91 million of order items in Q4 FY24. And in fact, if you see the growth between the Q1 FY25 versus Q1 FY24, we have delivered a growth of near about 7.5%.
Got it. No, that's helpful. So coming to the pricing trend, I mean, is it like there is some bit of a pricing pressure in the industry, or is it like because of increase in the number of volumes from your enterprise customers, your per item pricing comes down because of that? So can you just give us a highlight at a slightly higher level?
So our price steady state has been about 1.2 to 1.3 per item. It has stayed consistent, Sumit. It is a function of both as we add new enterprise clients, which typically are at higher scale and are able to get a lower rate, and also a mix of categories itself, where now we are seeing a lot of traction across emerging categories like beauty and personal care, health and nutrition, etc., where again the volumes are high, because of which they have a slightly lower rate. So it's a function of us being able to get higher enterprise clients as well as a category mix that's changing. But the price probably stayed consistent in the range of 1.2 to 1.3.
Got it, Kapil. That's very helpful. And if I see your enterprise customer growth, I mean, almost by 85 number, what you mentioned, it's almost a 10% growth sequentially. And I'm assuming this must have happened over the course of the quarter. And obviously, enterprise comprise 90% of your revenues, almost 85 to 90%. So does that imply that irrespective of how the festival season goes by, this addition of enterprise customers itself will give you a good sequential growth in the next quarter?
So, Sumit, customer additions is definitely a factor for us to drive growth, but the other factors are also important, which is the transaction growth. As I mentioned, in terms of our revenue growth driven by different customer cohorts. A large part of our growth continues to be from existing customers itself for the current year. So it's a function of transaction growth as well as new customer additions, as well as product revenue that we start generating from new products, plus international expansion. So our growth is a function of all these four factors.
Got it. And in terms of, I think, Anurag, you mentioned that you guys have capitalized almost 21 million expense around product development. So if I actually exclude that, or rather include back in your P&L, your EBITDA sequentially would have been slightly down. So just want to understand this R&D expense around new product development. Is it spread across employee benefits and other expenses, or how is it like? And is this policy change only in this quarter, or how is it?
Sumit, to answer this question, I want to clarify that we are investing in new product development, which we intend to commercially launch towards the end of this calendar year or early part of next year. Accordingly, the investments to build this product suite is capitalized, including manpower expenses. So today, all our revenues is from existing set of products only. Accordingly, for calculation of adjusted EBITDA of 4.5 crores, the costs considered are largely relating to the existing product suite, and therefore the adjusted EBITDA margins of 16% represents the true operating margins for the company. And post the commercial launch of the new products, the operating expenses will start getting expensed out in profit and loss account, having marginal impact on the margins. Even then we remain confident of our improvement in margins playing out.
And one more point to add, Sumit, that there is no policy change. We have, for all incremental enhancements, they still continue to be expensed. This is after a very long time we are actually building new products, and that's why those have been capitalized. It's a consistent policy that we have followed over the years.
Okay, and at a very high level, Kapil, just want to understand the 3-4 growth drivers you mentioned. If let's say one has to assume you grow in, let's say, 15 to 20% range, in that range in a given year, given that e-commerce CAGR has been in that range over a 5 to 10 year period. So out of, the 3-4 initiatives you mentioned in terms of new client addition, new products, international expansion, and the growth from existing client, these 4 areas, how will you distribute your 15 to 20% growth? Let's say, assuming, I'm not saying for a guidance here, but let's say if you assume that to be the range, these 4 growth drivers you mentioned, which will be the biggest and the least importance, if you can mention?
Sumit, as I mentioned, that our existing customers continue to drive a large part of our growth because we are linked to number of transactions. So transaction growth will continue to determine our growth. Then the new customers that we add in the year continue to add some contribution to the current year revenue growth, but more importantly, these are additions that help us drive future revenue growth. Because as I mentioned, the customers we acquired in the current year end up more than doubling in the next year because in the current year we only get average 6 months of revenue from them. Then new products, today they are very early stage. As I mentioned, they are in the build phase today, and we continue to incorporate client feedback to make them more mature. So today they are negligible contributor because we just pilot launched it with a few customers, and we are getting very positive response from the alpha adopters. And finally, international expansion. Again, we are expanding into new geographies while the product is pretty much ready for both the current and future needs in these geographies. But we have to continue to build a strong customer base in these geographies as well. So it will be in that order that we'll continue to demonstrate revenue growth for the business.
Got it. That's very helpful. And lastly, compared to your 9% revenue growth, any idea by how much the overall e-commerce market would have grown in this quarter on a YOY basis? Because we don't get any industry data particularly. So just taking a cue from you if you get any sense.
So Sumit, we continue to grow market plus. We have demonstrated that over many years now. So even in this quarter, as I mentioned, the market started to show subdued growth end of Q2 last year, and it continued to be subdued during the festive season and in Q1 itself, but we've seen some recovery happen towards the end of Q1. So at least our hope is that in the subsequent quarters, the growth will continue to be high. But as of now, the market in Q1 itself has been subdued, and we have delivered a market plus growth as per our estimates.
Got it. That's very helpful. All the best to the entire team and great show. Thank you.
Thank you. The next question is from the line of Nikhil Chandak from JM Family Office. Please go ahead. Mr. Nikhil Chandak, your line has been unmuted. Please go ahead with your question. Would request you to unmute your line from your side, please. The line for Mr. Nikhil has dropped. May I request we move to the next participant? The next question is from Ankur Pant from IIFL. Please go ahead.
Hi, sir. Good morning. I have a couple of questions. The first one is a short-term one. So we have delivered 9% growth in 1Q, and while I do understand that there is a positive seasonality heading into 2H, any reason you believe that this growth could be higher in 2H on a Y-on-Y basis, or is that completely market dependent? I'll ask my second question after this.
Sure. Thanks, Ankur. As you mentioned, that there is a seasonality. So we typically have seen that revenue in H2 is higher than H1 due to the festive season sales, as our revenue is linked to the number of transactions being processed. Last year, as I mentioned, we saw the e-commerce growth decline towards the end of Q2, and the growth continued to be subdued during the festive season last year. However, this year we have seen some recovery happen towards the end of Q1, which leads us to believe that we will continue to see higher growth in the subsequent quarters. The other factor, obviously, because the last year's festive season was subdued, we will also see a base effect and hope to see a higher growth in the second half of the season.
Sure. And any company-specific reason on that front, that or any new product or anything else which could lead to a higher growth uptick?
Sure. So, in terms of us, we continue to add enterprise logos. We've added one enterprise customer every day in Q1. So these customer additions will continue to demonstrate higher growth in the subsequent quarters. Plus, the new products, as we continue to build on them and incorporate feedback, there will be some additional revenue that will come our way. So it will be a combination of transaction growth, client additions, as well as some traction that we'll start seeing from new products as well.
Sure. Thank you. That's helpful. And my other question is a slightly longer term question. So just thinking from a 3 to 5 years perspective, what is the kind of top line and margins that you're looking at? Just a broader sense that you think of internally. And you mentioned that, and Unicommerce has been growing at market plus, but what kind of a growth differential that you expect Unicommerce to grow versus the market? Like 10% or what is the kind of number that you think is feasible?
Sure. So we have seen some softness in the e-commerce growth in the recent quarters, but the medium to long-term story of e-commerce growth is intact. As I mentioned, e-commerce market in India is highly underpenetrated because in India, as an example, if last year 4 to 4.5 billion shipments were processed, in comparison, 130 plus billion shipments were processed in China last year. So there is a significant headroom for growth for e-commerce market in India. Our estimate is that medium to long-term growth in e-commerce market overall should be 25% plus, and we've continued to deliver a market plus growth so far, which has been a combination of transaction growth, our customer additions, as well as now we have a new products lever as well. So we are hopeful that we'll continue to deliver a market plus growth in the medium to long term.
Thank you. That's very helpful. Wish you all the best.
Thank you.
Thank you. A reminder to all participants, you may press star and 1 to ask a question. The next question is from the line of Nikhil Chandak from JM Family Office. Please go ahead.
Yeah, hi, good morning. So, some few basic questions. The first clarification I wanted is, how much % of your customers would be on a fixed, fee kind of a model, say, for the year, versus per transaction kind of a revenue model?
So all our enterprise customers pay us a minimum subscription fees each month, and in which they are allotted certain quota of transactions in this cost. And once they exhaust this quota, they pay us an additional fees. All our customers follow this model. We continue to add new customers every year, and it takes a couple of quarters for them to expand their transaction base and exhaust this quota. So it is a function of the number of customers that we add in a particular year. But steady state, majority of our customers have already exceeded this quota of minimum transactions and continue to pay us the additional usage fees. But given that we continue to add new customers every year, they take certain time. So at an overall company level, this number may be different, but today, majority of our steady customers in steady state pay us an incremental or the usage-based fees. But the new customers that we add, they continue.
And the incremental usage-based fee is like a flat line kind of a structure, or there are some slabs beyond which the fee keeps reducing? So if the customer exceeds, I'm just saying, far too many transactions, does the fee kind of come down?
No, so most of our contracts are linear. So as the transactions of the customer grows, our revenue from that customer continues to grow in that line. There are few contracts that have slab-based commercials, so they get certain discount for increasing scale, but that's a very small portion of our contracts. See, for any e-commerce brand or seller, as the scale increases, they actually value the complexity we are solving for them a lot more compared to a customer which is at lower scale. So very rarely have we seen a customer demanding a discount as their scale increases, because we are helping them handle a large portion of this complexity very seamlessly, and they value this solution a lot more at higher scale. And that's why most of our contracts continue to be linear.
Understood. The other basic question I had is, so who would be your competition in the market? Would it be, or how smaller would be the other competition in the market? And would the company's in-house teams also be a competition for you?
See, the competitors for us are e-commerce first solution, given that we play in e-commerce enablement space. We have listed some of these players in our RHP as well. So these are players such as Incref, Vinculum, etc. But essentially, as I mentioned, we are a fairly dominant player. We are the largest player in the transaction processing layer by revenue for FY23, and the only profitable player amongst the top 5 players in the transaction processing layer as of FY23.
Understood. Perfect. And just the last question. So I'm just trying to picture, what is really the industry size for you? I'm not talking about the e-commerce players. I'm saying the e-commerce enablement segment. So, for example, you've done like a quarterly top line of roughly 27 odd crores, I can see, say for the last quarter. But what would be the industry size? Like, what is the TAM for the space?
Today, e-commerce, while it's been around for a decade, it's very, very nascent. A lot of brands today use Excel to manage their e-commerce operations. And very few brands today use a software to manage e-commerce, and that's where we see a significant headroom for growth, not just because of e-commerce being underpenetrated. The penetration of software being used to manage their e-commerce business is fairly low today. And as more and more brands see an increasing scale and increasing complexity, because for many brands, e-commerce today is just maybe selling on one or at best 2 platforms. But as brands start to grow, they realize that they have to be on multiple platforms, which is how a lot of large brands and retailers have operated in India. And as they get onto multiple platforms, as their scale increases, they realize that it is nearly impossible to handle this complexity manually or using Excel to manage their operations. And that is when they look for a solution. the overall TAM
Would you
for
want
the
to
market.
kind of put a number to it, just in case if there's some industry-wide number?
Yeah. So the overall market, the TAM for both the core products and the complementary offerings that we have offered is about $680 million. But as I mentioned, a large part of this market is today getting managed on Excel, so it is addressable. But as the complexity and the scale for the market increases, more and more brands will look for a software to manage their operations.
Perfect. Great. Thank you so much. All the best. Thank you.
Thank you. The next question is from the line of Rohan Nagpal from Helios Capital. Please go ahead.
Yeah, hi. Thanks for the opportunity. Quick question on, so if I just take your revenue.
May we request you to use your handset, sir? Your audio is not very clear, sir.
Hello. Am I audible?
Yes, sir. Please go ahead. Thank you.
Yeah. So if I just look at your revenue per item, it's gone from about 1.6-ish to 1.3, or is it 20-odd% compression year-over-year and a 4% compression quarter-over-quarter. With an increasing number of enterprise customers, do we expect this sort of compression to continue, or do we expect it to sort of stabilize from here on?
As I mentioned, the price for us, the steady-state transaction rate has been between 1.2 to 1.3 and continues to be there. The price changes that you've seen is a function of us acquiring more enterprise customers as well as the overall category mix is changing. But now, few levers that we are deploying to increase the prices, that in all our new contracts, we have introduced a price escalation clause. That is, and this we have introduced since last year. So now every new contract at the end of 1 year will have a price escalation already built in. And also, as we launch new products, like we've launched Uniship and Unireco, for the same transaction that is, or the same item that's going out of the warehouse, we are now able to charge additional amount using Uniship, which is providing tracking services for the same item that's going out, or using Unireco, that is providing reconciliation for the same item that's coming back as returns. So through these two levers, we will be able to see a stable to increasing price trend for a price per item.
Got it. Okay. That's helpful. And in terms of your expense base, I think last year there was between Q1 and Q4 there was about a 6% increase in the cost base. Do we expect a similar sort of escalation this year, or how should one think about it?
So the overall cost base, absolute cost base increase is for the employees, and that's a result of the appraisals that we do for our team in Q1. But if you look at as a percentage of revenue, our employee cost base as a percentage of revenue has seen a consistent decline over the last few quarters, and that is a result of the operating leverage that the business continues to demonstrate, because our cost base is largely fixed as the core business continues to grow, and there are not significant investments that are required in the business, and whatever investments we are doing in new products and international expansion continue to be there from our internal accruals itself. So as a percentage of revenue, we have demonstrated a consistent decline of employee cost as a percentage of revenue, and we'll continue doing that. Q1 is a result of appraisals, as I mentioned, and that is a seasonal, like every year, we do our appraisals in the Q1 of every financial year.
Okay, so it's broadly going to stay fixed from here on for the rest of the year?
That's true.
Okay, thank you.
Thank you. A reminder to all participants, ladies and gentlemen, you may press star and 1 to ask a question. The next question is from the line of Deepak Jain, who's an investor. Please go ahead.
Hi, Kapil. Can you hear me?
Yes, we can hear you.
Yeah. So my question was, what part of our expenses do we incur towards marketing expenses and development expenses? Do you disclose on that?